Hello, good evening, everyone, and welcome to this session on trading stock indices. So we're going to be discussing how you can trade stock indices, but what you really find out is that really trading any market really just really depends on you knowing a bit about the market you're trading. But really, when it comes down to strategies and how you actually trade the market, they all have the same principles, which you will see shortly. So let's get started trading stock indices. So of course, as you all know, very important part of trading is having a trading plan. And when you're devising your trading plan, one of the most important things you want to then decide before you start is what market you're going to trade. For example, when you're trading the currency market, like we start with, I advise everyone to start with Euro US dollar. But later on, the more comfortable you become with trading, analyzing the market, money management, trading psychology, and all that. And then, of course, most importantly, depending on money management, you can then start trading 2 or 3 other markets, like we did with money management part 2. So you can then decide you want to trade Euro US dollar, pound dollar, and dollar yen. But again, whichever market you choose to trade, you need to write it down in your trading plan and then stick to trading that particular market, not just jumping from market to market. Because the whole key to success as a trader is consistency. That's it. Always, whatever you do it consistently. So whatever market you want to start trading, you write it in your trading plan that you want to trade that market, and you trade that market on a daily basis. So that's one of the big things you can do with trading. And as we know, there are lots of different markets with sufficient liquidity to permit you to do prudent speculation and trade. But it's important to choose markets that are applicable for your account size, your risk level, and trading style. This is actually very important when it comes to trading indices, because the good thing about trading currencies or trading the Forex market is that the Forex market is very good to trade with any account size, any risk level, and any trading style. So that's the beauty of the currency market. So you can, anyone, as we've all seen, you can start trading it with 100 pounds or 500 pounds. You can be doing your 10 pips per 10 pips per pip. 10p per pip. And of course, it's not as risky as you soon see shortly when you trade indices. And any trading style can apply to currencies. Again, that's why currencies is the best market to trade, because it can fit any account size, any risk level, and any trading style. But with indices, it's not the case. Quickly, as an example, if you're trading the FTSE, it's less risky. The FTSE is not very volatile. It's not very crazy. So, the risk level is slightly low trading FTSE. If you're trading the S&P 500 and the Dow Jones, they're extremely volatile, high risk. You can lose money in 2 seconds. It's a crazy market. So with, with indices, slightly different compared with currency. But like I say, you need to decide which markets you want to trade in. Like I said, that's the key really. It's just making sure you put that in your trading plan, especially if you want to start adding indices to your currency trading. You need to write that down in your trading plan. But the good thing about trading a diversified portfolio is that there's a greater chance you will catch some of the truly great moves in the market, which make for successful trading. So the more markets you trade, the better, the improved success you might get in terms of catching huge moves in certain markets. But again, like we said, and if you haven't watched Money Management Part 2, please do watch it, because again, It's your money management that determines how many markets you trade. Because even if you decide to trade 10 different markets, you could lose on all of them. So again, never ever forget money. Okay, so that brings us to stock market indices, which is something else you can trade in addition to currencies. But you need to obviously know what is a stock market index. Because obviously before you trade anything, you need to know what you're trading and what you're trading. And of course, those who've done the investment course will obviously already know what a stock market index is, because we covered this at great length in the investing course. But basically, a stock market index represents the measured performance of the stock market of a given nation, and it usually reflects investor sentiment on the state of that country's economy. So basically, every country has a stock market. Every country has a stock market, whether it's, Egypt, Ghana, Germany, Canada, Brazil. Every country has a stock market. And the stock market performance in all these countries, they sort of mirror the performance of that country's economy. So you find that if a country's stock market is performing well, you can sort of infer that that country's economy is performing well. If a country's stock market is performing badly, you can sort of infer that that country's economy is performing badly. So just by looking at the performance of a country's stock market, that can give you an idea of how that country's economy is performing. But of course, the only way you can tell if a country's stock market is performing well or performing badly is for you to measure it. You need to measure it. So that mathematical calculation to measure the performance of a country's stock market is what an index is. So that's what an index is. So that index, just the word index, the word index means that is a measure, which is a mathematical calculation, is a measure of the performance of a country's stock market. So if you find that that mathematical calculation, if that figure is going up, you can say that stock market is performing well. If that figure is going down, then you say that stock market is performing poorly. And actually, this is what you now trade as a trader, trading the stock market index. You speculate on that figure going up or going down. If you speculate that the stock market is going to perform well, then you buy and profit with it going up. If you speculate it's going to go down, you can sell, go short, and profit from it falling. So that's what you actually trade as a trader, is when you're trading stock market indices, or indices is just a plural for stock market index. So when you're trading stock market index, that's actually what you're trading. You're speculating on the performance, and you're speculating on that measured performance, that mathematical calculation, that figure that has been measured every couple of seconds. That's what you're measuring. Sorry, that's what you're trading on to see if, the performance of that stock market is going to go up or go down. So of course, if you want to get more information about, whether you think that stock market index is going to perform well or not, you then need to know what that country's stock market index is. Number one, you need to decide what country you want to trade, which stock market, the stock market of which country, and then you need to know what the index of that country really is. Now, the most continually quoted market indices are what we call the broad-based indices, which are made up of the stocks of substantial companies, which are mentioned on the country's largest stock exchange. So you find that, each country has a unique way of the way they measure the performance of their stock market. So for example, let's use the FTSE as an example. There are over 2,000 companies listed on the London Stock Exchange. There are over 2,000 companies listed on the London Stock Exchange. But when you want to measure the performance of the UK stock market, when you want to measure how well it's performing, that mathematical calculation to measure the performance of the UK stock market, which has over 2,000 stocks, to do that calculation, they take only the top 100 companies listed on the UK Stock Exchange. So they take the top 100 companies, and it's that top 100 companies they use to measure the performance of the entire stock market, which has over 2,000 stocks. So that's why you need to know the way each country's stock market performance is measured if you're choosing to trade that country's index. So like I said, you have in UK, you have the FTSE 100. And the 100 tells you that they're using the top 100 companies to measure the performance of the whole stock market in the UK. In America, you've got two well-known indices they use. You have the Dow Jones 30, which they use the top 30 companies to measure the performance of the whole US stock market, or the S&P 500, which means they use the top 500 companies listed on the US stock exchange to measure the performance of the whole stock exchange. In Germany, you have the DAX 30. Again, that tells you they're using the top 30 companies to measure the performance of the whole German stock exchange. And then in Australia, you use the Aussie 200. Again, meaning they use the top 200 companies listed on the Australian stock market to measure the performance of the Australian stock exchange. The reason why I give this as an example is because the indices or the index I usually trade, these are the ones that I usually trade: the FTSE 100, the Dow Jones 30, the S&P 500, DAX 30, and the Aussie 200. And also they're the ones that are liquid enough and the spreads are tight enough for you to trade well. Now, there's what you call weighting when it comes to measuring these indices and assessing these indices. They're weighted, and you need to also know what this weighting is if you're going to be trading indices or stock market indices. Now, with weighting, they involve the total market capitalization of the firms, which are weighted by the effect on the index, so that the bigger stocks will make more of a difference to the index in comparison to a smaller market cap company. Okay, what this means in English, let's try to explain what that means in English. So for example, in the FTSE 100, like I said, the FTSE 100 is a UK stock index. That's the one they use to measure the performance of the UK stock market. And like I said, there are over 2,000 companies listed on the UK Stock Exchange. But most of those companies listed on the UK Stock Exchange are small companies. They're small in terms of their market capitalization. So you find that those top 100 that they use to measure the performance of the UK stock market are weighted heavily because they're large multi-billion-dollar companies. And market capitalization, in a short, when you're talking about market capitalization, is basically how much that company is worth. And the easiest and quickest way to find out how much a company is worth is just to say, okay, what is the current share price today per share? How many outstanding shares do they have? And you multiply the share price by the number of shares they have, and that will give you the value of the company. And if the company is, worth $20 billion and above, you can say that's a large cap company. And it's this sort of large cap companies that their performance of this large cap companies will determine whether the stock market as a whole goes up or goes down. So this is what weighting means. Because obviously those large cap companies, they have a lot of weight and they can determine whether the stock market will perform well or not. So let's give an example. So for example, in the US, we all know the AAA companies, which is Apple, Amazon, and Alphabet. Alphabet is obviously, is Google. So those three companies, they are huge. They're huge companies. So if those companies are performing well, they tend to drag the US stock market up. If those companies are performing badly, they tend to drag the US stock market down in terms of the index. So this is what you mean by weight. So you can see there's a lot of weight put on those companies because of their total market capitalization compared to one company that maybe is a small company listed on the US stock exchange. If that small company is performing badly, it might not make a huge difference on the US stock market compared to Apple, Amazon, and Google. So we also have what we call this. So this is where you have this price weighted index, so such as FTSE. So the FTSE is classified as a price weighted index, where the cost of each component of stock is the sole consideration when determining the value of the index. So basically, when you're trying to calculate, again, you don't have to do that mathematical calculation. It's an extremely complex calculation that is done automatically. So you don't have to do it. But while they're trying to do that complicated calculation, when they're calculating the index, the performance of the FTSE, for example, they take the share price of each of those top 100 companies listed on the FTSE, on the UK Stock Exchange. They take their share price at that particular time. Then that's what they then use to calculate the value of the index. And like I said, this calculation is done, every couple of seconds. So like I said, companies are typically divided according to their market capitalization. So you have what we call large cap companies, which is companies that are worth $10 billion or more. You have mid cap companies, which are $2 billion to $10 billion. And you have small cap companies, which are $300 million to $2 billion. Let's just quickly go to the website. We'll probably use, let's pick Apple. Like I said, Apple, Amazon, and Alphabet. Those ones, you always know there'll be big companies. AAPL, that's Apple. So let's look at Apple. So you can see here the market cap here. So you can see the market cap overview. So that you can see the market capitalization for Apple is $2.07 trillion. So you can see it's a huge, huge company. It's worth $2.7 trillion. So basically what I'm saying is that the way they calculate that market cap is, you can see the share price today for Apple is $126. And you can see the shares outstanding. They have 17 billion shares. So it would be $126.94 multiplied by their 17 billion shares. And that's what will give you their market capitalization of $2.something trillion. So you can see that's a huge company. Let's just quickly look at Amazon. So you see, so this is why you can see these companies, they create a lot of weight. So if you're going to trade indices, for example, if you want to trade the S&P 500 or the Dow Jones 30, you need to know how these big companies are performing. The Alphabets, the Amazons, the Apple, the Microsofts, all these big companies, you need to know how they're performing, because they are the ones that will determine whether the Dow Jones will go up or fall. So you can see this is Amazon. Their market cap is $1.58 trillion. So you can see this is a huge company. So that's what we're talking about when we talk about market cap. Let's go back to the presentation. So like I said, you have the large cap, like I've just shown you, there are 10 billion and above. So you can see the ones I showed you, Apple and Amazon, they're well above 10 billion. They're the trillions. And then you have mid cap to 10 billion, small cap 300 billion to 2 billion. So these large cap companies are the ones that you need to watch out for when you're trading indices. You need to check, when there's news about those companies, when they're having a company earnings release and all that, you know, that could then have an impact on the index, the stock market index as a whole. You have other types of weighting where you have what you call market value weighted or capitalization weighted index, like the Hang Seng index, which also factors in the size of the company. Because like I said, in the previous example we're giving you with the price valued index like the FTSE, they will just take, you know, what the share price of the day is with those top 100 companies and do their calculation. But with some other indexes or some other stock markets, when they measure the performance, they also take into value the size of the company. Yeah, you know, how big are they? You know, are they multinational? Are they across different countries? You know, or it's just one small company with a few shares. So they take all that into consideration when they're doing their calculation. But again, this is all just academic. You don't have to do all this calculation, but this is just from a theory point of view. And then obviously we're getting some new innovations coming on how to construct stock market index. But these are just innovations which are not commonplace now, but it's something to watch out for the future. These innovative techniques of index construction, which they feel will supplant these traditional market capitalization weighted indices, you know, that we're used to. So they're saying that within the next 20 years or so, these new innovative ways of calculating and constructing indices might supplant this traditional ones we know of the FTSE 100, the Dow Jones 30, S&P 500, the DAX 30. Those are the traditional ones that are still useful today. They're the ones that are recognized and used worldwide. But yeah, it's just to let you know that, you know, things are afoot and things might be totally different in years to come. So they're saying that this market cap indices, they face new rivals. You know, a number of alternative approaches have emerged lately, such as what you call the fundamental indices. And of course, you can see this is quite complicated. Fundamental indices is which stocks are weighted by their metrics like book value, their dividends, their sales, minimum variance, you know. So you can see they're bringing more and more complicated stuff. But again, all these things are not in widespread use at the moment. But it's something that is just to watch this space. So you can see FTSE has recently launched a family of risk-efficient indices. You know, this covers the UK, US, Eurozone, Japan, and Asia Pacific, excluding Japan. And they found that they've sort of outperformed the standard indices in back testing. But again, these are just all new fancy innovations that are coming in that might replace the indices that we know in the future. But that has not happened yet and not going to happen for the foreseeable future. So let's just look at the FTSE as an example of an index in even more detail. The FTSE just stands for Financial Times. So the FT in FTSE stands for Financial Times, and the SE is Stock Exchange, obviously the London Stock Exchange. So that's what FTSE stands for, Financial Times Stock Exchange. So the FTSE is a share index of the 100 most highly capitalized UK firms noted on the London Stock Exchange. Now, this FTSE or this index began on the 3rd of January 1984, and it started with a base level of 1,000. So that's when the FTSE index started, 3rd of January 1984, and it started at the level of 1,000. And it's gone up, the highest has gone up to, it's to date was a level of 7,902 on the 1st of May 2018. And let me just quickly show you that actually. So let's look at the FTSE. So there's the FTSE. There's a daily time frame. So you can see that, you know, this is what they're measuring. And this is FTSE 100, like I said, the top 100 companies in the UK listed on the London Stock Exchange. So obviously this was during the COVID pandemic. So you can see when the UK stock market fell, but this is what the FTSE is measuring. It's measuring the performance. And you can see the performance of the UK stock market performed badly during the COVID crisis. You can see the dates there. This was around February, March of this year. And then started to go back up. And now you can see, it's doing quite well compared to that massive fall in February, March. But if I just go to the monthly time frame, so this monthly time frame takes, this monthly time frame takes you all the way back to 1999. But you can see this is where the highest point was there, which was the 1st of May. And that highest point there on that 1st of May was 7902.8. So that's the highest it's been so far. And like I say, it started at a level of 1,000 in 1984. But that's what you're going to just be speculating on as a trader when you're trading indices. You're speculating on that calculation. Is it going to go up or go down? If that calculation goes up, you buy. If it goes down, you sell. So this, excuse me, the index is maintained by the FTSE Group, which is an independent company, which originated as a collaboration between the Financial Times and the London Stock Exchange. That's why they have the name FTSE. And it's figured out in real time and published every 15 seconds. So like I said, they're the ones that do this complex calculation. They do it in real time. And every 15 seconds, the figure comes out. So every 15 seconds, they will calculate, they will take the current price of all those top 100 companies listed on the London Stock Exchange, do their crazy calculation, and the figure comes out in 15 seconds. Then they do that calculation again in another 15 seconds. So obviously, if the stock market is performing well, the number will be going higher and higher. If the figure, if the stock market is performing poorly and share prices are dropping, and that figure will be falling, like you saw on the FTSE chart during the COVID crisis. But obviously, when you're also trading indices, you need to know what companies are listed on that, because just like I showed you with the American market, with the Dow Jones, with the US, if you're trading the US market, you need to now know that Amazon, Apple, Alphabet, Microsoft, all these big companies, you need to know they have a huge impact on how the index performs. So you need to know, if you're trading the Dow Jones 30, you need to know which are those 30 companies that are listed, the top 30 that are listed on the US stock market. If you're trading the S&P 500, you need to know which are these top 500 companies listed on the US stock market. And of course, if you're trading the FTSE, which is the example here, you need to know, okay, which are these top 100 companies, because you need to know them. Because if something is happening to them, they would have an effect on the value of the FTSE and whether the FTSE goes up in value or falls. So if you want to trade the FTSE, you need to know which are these top 100 companies. Of course, you can just Google it. This is FTSE, for example. So you need to know these are the companies that are listed as the top 100 in the UK. Of course, you've got many pages to go through, but if you're serious about trading the FTSE, you need to go through that list and have an idea of all these companies. Because if you find that, for example, now there's news that the head of Admiral Group has been fired, or there's trouble with Admiral Group, or the earnings release is poor, then that could have an effect on the FTSE, because obviously it's one of the companies listed in the FTSE 100. Same with Morrison, same with BAE Systems, same with HSBC. So that's why you need to know all these companies are listed, because whether their performance, whether for good or for bad, will reflect on the FTSE. So it's the same you do if you're trading the Aussie 200, the DAX 30. You need to know those companies listed on those index, so that, because that's going to be part of your analysis when you're checking the market watch For example, now, let's go to the home page. So you can see that's why we always say that currency trading is much easier because you can see there's more work for you to do if you're going to trade the stock market or stock indices. You need to know which companies are listed on that stock and on that index, and you need to keep an eye on what's happening with those companies. So when you're now checking Market Watch, you know, with currencies, we are just looking for major news. But when you're now trading indices, you now have to be more particular. You have to now check even more as to, you know, which companies. You can see here about Apple, Disney. So you might, if you're trading indices now, you're trading the Dow Jones, you might need to be aware of all this information that's coming out about these companies that are listed on those indices. So you can see there's more work and more things to check if you want to trade indices and trade them successfully. Okay, so you need to know, and that's why you need to know the list of companies listed. Because if you're trading FTSE and then you see there's something there on Tesco, then you need to check. You know that might affect you trading the FTSE. So more work compared to currencies. So like I said, the FTSE 100, like I said, when you look at the London Stock Exchange, there are over 2,000 companies listed on the London Stock Exchange. But the FTSE 100 is they're just using the top 100 out of the 2,000. They're using those the top 100 to measure the performance of the whole UK stock market. And that's because those top 100 companies, they represent about 81% of the market capitalization of the entire London Stock Exchange. And I've explained to you what market capitalization is. So those top 100, they're so huge, they're multi-billion-dollar companies that when you take the combined value of those top 100, they represent, you know, over 81% of the value of the entire London Stock Exchange. So like they say, although the FTSE All-Share Index, the All-Share Index obviously takes into account all the stocks listed on the London Stock Exchange. So although the FTSE All-Share Index is more comprehensive, but the FTSE 100 is by far the most generally used UK stock market indicator. And then like I said, same in America. The most widely used in America is the Dow Jones 30 or the S&P 500. In Germany, the DAX 30. In Australia, the Aussie 200. So you can see the net market capitalization of the FTSE 100 index. So just the net market capitalization of just the top 100 companies listed on the London Stock Exchange was £1.8 trillion as of May of this year. So huge. So what are the things that affect trading indices? Same as the currency trading, economic data will affect it. So if you're trading indices, the same things you check for currency trading, you will need to check for indices. So inflation rate, gross domestic product, interest rates, unemployment. So reports of high importance, you need to also check the economic calendar when you're trading indices. So if you're trading the FTSE, for example, then you need to be aware of reports of high importance coming out of the UK, and of course, note reports of medium importance coming out of the UK that can affect the FTSE. Of course, if you're trading the Dow Jones or the S&P 500, you need to be aware of reports of high importance that could affect coming out of the United States. Of course, you all know that reports out of the United States would affect all markets. So whether you're trading Aussie 200 or DAX 30 or FTSE 100, you seem to be aware about reports of high importance coming out of the USA, because reports out of the USA of high importance affects all markets, all stock markets, all currency pairs, all commodities markets, fixed income markets. They're all affected by reports coming out from the United States. So the same thing you do with currencies when it comes to checking the economic calendar is the same thing you do with trading indices. But in addition to that, you need to be aware when the companies are releasing their earnings, because companies listed on the stock exchange, by law, they're meant to release their earnings every quarter. So during this earnings release, when they're all releasing their earnings, you need to be aware of that, because if the outcome of the earnings will have an effect on their share price and on the index. So you need to be aware of that and check that. So again, this is more work you need to do as if you want to trade indices successfully. You need to be aware. Like I said, number one, you need to know about those companies. So if it's FTSE 100 you're trading, you need to know about those top 100 companies, the names of those top 100 companies. Then you need to be aware about when their data has been released. You then need to also be aware about company news and market news. Like I said earlier, you need to know if they have just fired the CEO of Apple, or they just fired the CEO of Tesco, or there's a scandal in HSBC. You need to be aware about this company news, because it could obviously affect that company's performance. It could affect their share price, and of course affect the value of the index. And of course, although this adage is no longer, so much has happened in the last couple of years that this adage it no longer rings true. But in the past, they used to say, when it comes to the stock market, you buy in November and sell in April. So basically what they're trying to say is that the market tends to go up from November till April, and the market tends to fall from April to November. But that doesn't apply anymore. But that was the former adage that, you buy in November and sell in April. But you can more or less ignore that. That's just there for historical purposes. The markets have changed drastically since that. The market now, there's so many things and so many factors now that the market has a mind of its own. So we said about earnings season. Went too fast. So we said about the earnings season, you need to be aware about earnings season if you're going to trade indices, because they have a huge impact on the stock market and the stock index. So the earnings season refers to the months of the year during which most quarterly corporate earnings are released to the public. And this earnings season typically falls in January, April, July, and October. So, in the new year in January, we're going to have the next earnings season where all these big companies will be releasing their earnings. Of course, if their financials are doing well, then, the stock market tends to go up. If their financials are bad and they miss the target, then it might affect their share price negatively and the index will fall. So if you're trading in indices or trading an index, you need to be aware when this earnings season is about, and let's see what the outcome of the earnings results are. So that's why I say yes. I think you all begin to see why they say currency trading is much easier, because the information you have to get to trade currencies is so little compared to information you need to be aware about when you want to trade stock markets or stock indices. Of course, when you're going to trade the stock index, the best time to obviously trade them is when the market is open. So you need to trade them during the market opening times. So you need to be aware about when that market opens. Now, these times I'm going to show you are UK times. Obviously, you have to take into account, summertime changing and all that stuff. But this is just a rough guide. So market opening times is all UK time. So if you want to trade the FTSE, for example, the best time to trade FTSE is when the UK stock market is open, which is between 8 a.m. London time to 4:30 p.m. London time. So that's the best time to trade FTSE. And just like currencies too, if you want to trade FTSE, provided there's no public holiday in the UK, provided there is no report of economic high importance coming out, you should really be ready to trade the FTSE from the time the UK market opens at 8 a.m. in the morning. So if you're trading FTSE, you need to be ready for 8 a.m. to trade FTSE, because it starts getting very active and volatile from 8 a.m. till it closes at 4:30. So that's the time you'll be trading FTSE. If you want to trade Dow Jones, the US stock market, then of course, You trade it during the US stock market opening times, which is 2:30 p.m. to 9 p.m., again, London time. And then if you want to trade DAX 30, that's German stock index, you do that between 7 a.m. and 9 p.m. Aussie 200, you do that between 10:50 p.m. and 5:30 a.m. So depending on which index you want to trade, and like I said, these are the four I used to trade regularly. I used to trade this indices a lot. Not so much now, but yeah, in the past, I used to trade all these indices on a regular basis, including the Aussie 200. So yes, depending on which index you want to trade, you need to be aware of the market opening time, because that's the time you'll be trading that index. Okay, let's go to the charts. So just to make it very easy, the interesting thing is that my trading strategy to trade the index is exactly the same trading strategy I use to trade currencies. It's actually no different. So again, let's go to the FTSE. So if I want to swing trade the FTSE, again, I will use the moving average 50 to swing trade FTSE using the daily time frame. So this is the daily time frame. So if I want to swing trade FTSE, I'll use the moving average and I'll use the same exact strategy I use for swing trading for currencies I use for indices. And if I want to day trade indices, again, it's exactly the same. I use the pivot point strategy to trade FTSE. And again, it's still the same money management. For FTSE, again, it's still the same 20 pips stop loss, 60 pips profit limit using the pivot point strategy. But I must tell you that the FTSE is a very slow, it's not very volatile. So I tend to mostly swing trade FTSE. I don't tend to day trade it, because to capture 60 pips for FTSE it's difficult. It's not volatile. It's a very slow market, so it's better for swing trading. The Dow Jones, this is an extremely volatile market. So again, the same thing too. I use the daily time frame, swing trade, moving average 50, and then day trade 5-minute pivot points. Same strategy I use, but with the Dow Jones, this is where, again, like I said, it depends on your account size. Because even if you want to day trade, even if you want to day trade Dow Jones, you might need a stop loss of about 30, 40 pips, because the Dow Jones is extremely volatile. It's extremely volatile. So, you know, if your account size is small and you're not willing to risk a lot, then the Dow Jones and the S&P 500, you probably best avoid them, because you might need to risk more pips. It's very volatile. You know, it will easily take your 20 pip stop loss, easily. It's very volatile, but because of that same volatility, it can be extremely profitable, because the way it will easily take you out for 20, 30, 40 pips, the same thing to the Dow Jones going up 100 pips a day, 200 pips a day, it's normal. It's normal for the market to move 100, 200, 300 pips a day. That's not unusual when it comes to the Dow Jones. And in fact, if you go to Market Watch, you can see that today, the Dow Jones went up 372 points or pips. So yes, Dow Jones can be very lucrative. It's very volatile, but that volatility works both ways. So you can either take you out of the trade very quickly and you lose a lot of money very quickly, or you can make a lot of money very quickly. So this is where, you know, if you don't have a lot of money in your account and you're not ready to risk, your risk appetite is not high, you might want to avoid S&P 500 and the Dow Jones. The DAX is somewhere in between. So the German DAX 30 is somewhere in between the FTSE and the S&P 500. So it's not as volatile as the Dow Jones, but is more volatile than the FTSE. So it's somewhere in between. So this is the one I used to like to trade a lot. It was the German DAX 30 in terms of day trading. So my preferred index for day trading tends to be the German DAX. But again, same principle, swing trading, I use the moving average 50. Again, same thing for day trading, I use the pivot point strategy. Okay, so like I said, that's the beauty about the strategies I use in terms of my swing trading and my day trading. I can apply to all markets. So it makes my trading easy because it's the same strategy I use for all markets. But like I said in the presentation, there's more information I need to gather when I'm trading indices than when I'm trading currencies. Because with indices, like I've said during the presentation, you need to know which companies comprise the FTSE 100. You need to know what's happening to those companies. You need to check the news about those companies. You need to know when they're doing their earnings release. So there's more information in addition to the economic calendar, checking for reports of high importance and medium importance, public holidays, and all that. Okay, so any questions? If you have any questions, you can either raise your hand or send your question to the chat box. Any questions? Oh, maybe I've put all of you off trading indices. You've all been put off. Or you all just say, okay, I'm just going to stick to currency or forex trading. Any questions? NASDAQ 100, again, is the same, regardless of whether you're trading the NASDAQ 100, the Hang Chai, they're all, like I said, the principle is the same. So if you want to trade the NASDAQ 100, you need to know what companies comprise the NASDAQ 100, and you need to be aware of what's happening to those companies that comprise the NASDAQ 100. And again, if you go to your platform, you can look for all those indices on the platform. Let me see. So that's the NASDAQ there. So again, it's really the same thing. So this is the NASDAQ. But like I said, it's the same thing. You still need to know which companies comprise the NASDAQ 100. Be aware about news about those companies that comprise the NASDAQ 100. And be ready to, but again, if I was going to, I don't trade the NASDAQ 100, but if I was going to trade it, it will still be the same pivot point strategy for day trading and moving average 50 for swing trading. But like I said, you need to know what companies comprise the NASDAQ 100 and look out for the news in relation to that index. But like I said, the principles are the same for whether you're trading the Japan index, the Hong Kong index, the Singapore index, principles are all the same. Just wanted to know your opinion of it. I have been trying my hand on it. Like I said, I don't trade the NASDAQ. Like I told you, the ones I trade was the German, the DAX 30, FTSE 100, the Dow Jones 30, S&P, and Aussie 200. So those are the ones I have experience of trading, and I can tell you about their unique qualities. Any other index other than that, if you choose to trade that, then you probably find out for yourself when you trade it, their unique characteristics. But like I said, the principles are the same. You need to know the companies listed on that NASDAQ. You need to know the opening times of that. You need to, for any index you want to trade, you need to know about the country, the companies listed on that index of that country. You need to know about the companies, their earnings release, and the same thing too about economic reports, economic calendar, public holidays, and all that. What's the advice stop loss for the different indices, given some move more than others? Like I said, for all the indices, I use 20 pips. The only one that I don't use 20 pips for is for Dow Jones because it's extremely volatile. But other than the Dow Jones, where sometimes I use 30, 40 pips, But for FTSE, DAX, and Aussie 200, I use 20 pips stop loss for my day trading. Why do you buy when the calculation goes up? Oh, again, actually, that's a good, just like I said, you can see here, the fact the market is going up here, this is the Aussie 200, but it doesn't matter. This is the Aussie 200 index. So this is the market going up here. So the market going up here means that the calculation means that the figures they're calculating is getting higher and higher. So that's why you see this is going up. And of course, if it goes up, you want to buy. So here, when the market is falling, that means that all the time they were calculating this Aussie 200 index, the value was falling. So that figure they were coming up every 15 seconds, the value was falling. It was getting less and less. So same thing like a trading. If the value is falling, you want to sell. If the value is going up, you want to buy. So I think it's really, that's what it is. And going back to that COVID crisis, so you can see here when the COVID crisis hit, and this is the FTSE 100 now. You can see that this is the UK stock market falling. But the way you know that the UK stock market is falling is because you're looking at a UK index that is measuring the performance of the UK stock market, but is using the top 100 companies. And that measurement, you can see, it will be the figure will be getting lower and lower and lower. So if you look at the data window there, you will just see that, you know, the figures go from 7,000 to 6,900 to 6,600 to 6,400. So that figure is falling. And of course, as you know, if the market is falling, you want to sell. Now that the market is going up, that means that the figure they're calculating on every 15 seconds, that figure is getting higher and higher, and you're looking to buy. But of course, that's just talking in general. If obviously you want to be more specific, that's where your trading strategy comes in. Like I told you, the same strategies I use for currency trading is exactly the same strategy I use for trading indices. This Japanese Nikkei seems to be doing well. I presume the same analysis is needed. Yes, like I said, exactly the same for any index you're using. The principles are the same. I just use those as examples because those are the ones I personally been trading for 20 years, so I know them very well. The FTSE, the German DAX 30, the Dow Jones 30, S&P 500, and Aussie 200. So those are the ones I have personal experience of trading those particular indices over the last 20 years. So I know the way they behave or misbehave, so to speak. And why do you sell when the calculation goes down? I think that's a whole. I think the question I should ask is whether you understand the concept of selling in the market. Which is what I explained in detail. I'm not sure if you came for the trading course, but yeah, in the trading course, I explained in detail, which is some of the basics of trading, how you profit from the market falling. And that's the concept of going short. So yes, as a trader, you can profit from the market falling, you can profit from the market going up. So if the market is falling, you can go short, sell, and profit from the market falling. And if it goes up, you can go up, which is, you know, there are so many different terms. If it's going up, if it's bullish, you go long, you can buy and profit. But I think those are where the basics come in really of trading. And those are the basics of trading, you know, in terms of understanding, you know, the market can trend up, down, or sideways. If it trends up, you're looking to buy. If it trends down, you're looking to sell. If it's trending sideways, you want to keep out of the market. But that's a whole topic in itself, which takes us back to the basics of trading. But like I say, if in general, the principles of trading applies across the board. The principles of trading it's no different. Whether you're trading stocks and shares, indices, currencies, commodities, the principles of trading are the same. The only thing is that when you're trading a particular market, you just need to know a bit more about that market that you're trading, which is what I've just shared with you when it comes to stock indices. If you're trading stock indices, you need to know about the index you're trading, the companies that comprise that index, and the sort of information that can affect those companies. Hello, Elizabeth.
Hello. Hiya. Right. What I need to find out, or what my question is, you know, all this analysis that you're doing. For example, now, if I'm thinking of trading the FTSE 100,
Yeah.
And the market opens at 8, like you said, can I do my analysis the day before and assume that it will stay the same, or do I have to do it in the morning of the day of trading?
You cannot assume.
No, because if I'm thinking, okay, the market's not gonna, they've closed at 4:30. I do my analysis at 6 o'clock. I'm not expecting any transactions or anything.
No, there's after hours trading. There's after hours trading.
Oh, it has to be that difficult. Okay.
Yes, unfortunately, the market is not static. Actually, let me show you. That's a good exact question you asked, because you can see here, it's 9. Well, I was going to say it's 9. Well, it's almost 10 o'clock here in Rwanda, but that means it's almost 8 o'clock in London, isn't that right?
Yes, it is.
So, but you can see there's still activity on the FTSE here, and it closed 4 hours ago.
Okay.
So if you had analyzed it around 6, let me look at where 6 is now. Where is 6? 6. Okay, so 6 is around here. So you would have analyzed it here and made your decision here, but you can see the market has changed since 6 o'clock.
Yeah.
Coupled with the fact that at midnight, the pivot points will also change.
Okay. Good point, yeah. That's okay.
And also, again, but I'm happy you mentioned that, because again, this is where you have to be careful and wait till 8. Because you might find, okay, the market opens at 8, but you check the market watch at 7 in the morning, and they say, okay, the CEO of Tesco, something has happened. Or you find out, okay, all of a sudden, Bill Gates has sold all his Microsoft shares. So that news can affect the index. So when it opens, it might open and fall because of that bad news. So yes, basically you can't make decisions way ahead of time. No.
Okay.
Sorry.
That's okay. But this is a little bit of a sub question as well. So if you do your analysis in the morning, for let's use the DAX 30.
Yeah.
And you look at the 30 companies that are there.
Yeah.
So if you have 15 of them that you think favorable, and the rest, the other 15 non-favorable, would you actually base your decision on their ranking? Yeah, that's the question. Would you base your decision on the ranking?
No, because I mean, that's the beauty about technical analysis, because most of what you want to get can be analyzed just on the chart. It just makes it easier for you looking at all. So I mean, you can see here, for example, that you can see the DAX here trending up. So yeah. it really doesn't matter what those individual companies. But again, don't forget, it's a combination of information. It's not just one information. So, for example, now, if you now know, for example, Siemens is one of the big companies in Germany, and it carries a lot of weight on the DAX. So, for example, now, if I bought the DAX now and the market is going up, isn't that right?
Yeah.
And then all of a sudden the news flashes that, you know, Siemens is in big trouble. That tells me that, oh, my DAX might fall. I might need to come out of my buy position. But again, I'm just giving you this as rough examples. I'm not saying it's, So, and that's why it's important to know those companies. And of course, don't forget there's economic reports. There might be a Germany report on unemployment coming out. There might be German interest rates coming out. There might be German GDP coming out. So you can see it's not just one thing you're looking at.
Okay.
So that's, again, it goes back to what I said. In fact, that's actually why I don't teach indices during the trading class. That's why I teach currencies, and that's why I always highlight to people why currency trading is easier. Because with currency trading, the information you need to analyze and check out for, as you can see today, is way less than what you need to check out for when you're trading indices. I mean, I just noticed there. So you can see here on the market watch, I mean, if you are trading the US stock market now, you can see here where it says here AM. So, I mean, we would ignore information like this when you're trading currencies. But when you're trading indices, you need to be looking at the market watch in more detail, because you can see here where they say AM's entertainment stock plunges after disclosure of massive share sale plan. So, like I said, if this was them saying that this was what Warren Buffett, no, I keep saying Warren Buffett. If they said this was what Bill Gates was doing about his Microsoft shares, he's dumping it, he's selling it, people wonder, oh, what's going on?
Yeah.
And then that can now affect the index. I'm not even sure whether I don't think AMC is in Dow Jones 30. But again, this is what you need to check. Is AMC part of the Dow Jones 30 or S&P 500? Hey, in fact, this is another good example here. You can now see what I was saying. You can see the Dow, it went up 350 points today. And that's because of Apple and Walt Disney shares.
Okay. You can tell I'm excited about this one.
So, yeah,
wow.
it's
a lot of
but this is why I say about Dow. It's very profitable, but that's if you get into the right side of things. If you're on the wrong side of things, you will lose money very quickly. It moves up and down very quickly. But you can see when we're trading currencies, we ignore all this.
Yeah.
So we don't care about all this. But yeah, when you start trading indices, FTSE, you're going to be looking in tiny detail about all this, the GE stocks, what is happening there, what's happening here. So you can see there's more information you need to take into consideration that will give you an idea whether that market, the index is going to go up or go down.
It's more or less like doing your analysis for when you're doing investment, right? Even more, it looks like.
Yes, exactly.
Wow. Okay.
Exactly. But the good thing about investing, you don't need to do this on a daily basis, because what you're trying to do with trading is trying to capture those points on a daily basis. And that's where the stress comes in. Because with investing, as you know, you just do your fundamental analysis, see if it's a solid, profitable company, buy it and forget about it. Or just buy an index fund that tracks that index and leave it alone for years. So that's what makes investing sort of easier, because you just do your analysis once and just buy it. But with trading, you're looking at what's happening on a day-to-day basis.
Mm. Okay, thank you.
Pleasure.
Hello, good evening.
Hello.
This is Sammy speaking.
Oh, hi. I just saw S. Hi, Sammy.
I'm fine, thank you. With regards to the in buying like the index funds, I'm looking at it from an investment point of view. So for instance, you said the index is what FTSE 100. Giving an example, the FTSE 100 is 7,000 plus now.
Yes.
Obviously, I don't have 7,000 to drop for.
No. 7,000 points, not pounds.
Oh, 7,000 points.
Points.
Okay.
Yes.
Okay. All right. So, okay. So, So that means I can start with any amount.
Yes, yes. So, okay, that's a good question. So yeah, if you're trading FTSE, for example, it's actually still boils down to the same as trading currencies. You need to know, let me bring up the other ticket. So you need to know what 1 pip per point is. So for example, here, you can see this 6547. Can you see that, Sam?
Yeah, it's I'm using my phone, so it's really small. Sorry.
Okay.
Right. I think
yeah,
I can see it. I can see it now.
Okay, yeah. So with the FTSE, you start counting your pips from that 47.
Okay.
So if it goes up to 48, it's gone up 1 pip, 49, 2 pips. So it's already told you here that £1 per point. So
Okay.
if you do a volume of 1, that means you're risking £1 per point.
Okay.
And again, it's just the same thing. So again, if you only want to risk, say for example, 20 pips. Okay, let's stick with £1 per point. So if you go for a volume of 1 and you put a stop loss of 20, that means you're risking £20. I mean, yeah. And then you can, so again, it's still the same, still the same money management. If you want to do 50p per point, you change it to 0.5. And so yeah, it's the same thing. So you can still use the same £500 to trade FTSE or Dow Jones, and it's the same with Dow Jones. Let's go to Dow Jones. So with Dow Jones too, you can see it's £1 per point.
Okay.
And again, you start calculating from that last. You ignore the decimal point. You just start calculating your pips from the last one. So yes, the same money management applies.
Okay, but when it comes to investing, as in how does that work? Is it as in the figure that is being shown on TV, as in that those are points, not currency?
Exactly. Yeah, exactly. So when they say the FTSE has gone up 10 points, basically what they're just saying is that the stock market is performing well. That's just the information you get from that. So for example,
so there's no equating it to currency.
No, not at all.
So like I can have like £1,000 and put it in there and just see what do you call it? Sorry, my kids have come into my brain. And I just see it's going up, because all along I thought that amount was actually currency.
No. It's just points. Period.
Okay.
Just points.
Okay.
So if I like what they've done here, for example, so you can see here that they've said Dow Jones has gone up 350, but that's 350 points.
Okay. All right.
Now, from an investor point of view or a trading point of view, those points are just academic.
Yeah.
Now, if you were trading Dow Jones, so if you were trading Dow Jones yourself, and they said it's gone up, then yes, depending, and if you capture those 350 points, then it then depends on how much were you trading per pip.
Yeah.
So if you were doing £1 per pip, then you'd have made 300 and something pounds.
Yeah. Okay.
So, yeah. But so that's the only place where the figure might matter to you as a trader, because that's how much you've captured. Now, but as an investor, that's all you just know as an investor is that the stock market is performing well. Period. It has no dollar or pound value to how much you've invested.
Okay.
It just says that, okay, yes. Because obviously, if you invested in the UK index, for example, you will want the UK stock market to perform well, isn't that right?
Yes.
Okay, and then if they said the FTSE went up, all it just says that, yes, the FTSE is performing well.
Okay.
But that's not giving you any information as to how much it has gone up in actual value terms.
Okay. All right. Okay. Fine. Thank you very much.
Pleasure. Elizabeth, I see you've given up on index. You said FX is definitely the way forward for you. But I think that's a good thing, because I think, FX is easier to trade, it's more profitable, it's more volatile. it's less stressful. So even I, like I said, I think even myself, I trade more currencies than indices. In the past, I used to trade it a lot when I had a lot of time on my hands. But now that I have less and less time on my hands, I rarely trade indices and more currencies. Any more questions? Okay, so if there are no questions, I wish you all a very, very good evening. Of course, the recording as usual, will be posted on the platform when it's ready. You all be notified. And yes, if you decide to trade indices, the 3 M's still apply. And trading psychology, money management, very important, especially money management, especially if you're trading the Dow Jones at the S&P 500. And again, method. And like I said, the method I use to trade indices is the same method I use to trade currencies. Okay, so have a good evening, everyone.